Roth IRA versus the traditional IRA. And of course the question becomes well, which one should I do? Just because he moved them all to Roth does not necessarily mean you need to be doing that. Just want to note that. Which is going to be best for us? Do we pay taxes now or do we pay taxes later? Giving us an answer to our question, Roth versus traditional, which one should I do? The official answer is, all right, and welcome in to another episode of CFP Reacts, where I, your host, Scott Schiller, reacts to the best and worst financial planning advice in social media. And in today's video, we're gonna be breaking down a very, very common topic that comes up in almost all of my planning meetings here lately, it seems like. And I thought I would do a video on this for you guys. And this one is gonna be on the concept of a Roth IRA, which is an individual retirement account, Roth IRA versus the traditional IRA. And of course the question becomes well, which one should I do? Which one is better for me? And so we're gonna be reacting to a video from Matt Sorensen, who's a wealth lawyer, and he's gonna be breaking it down for us, and I'll be reacting to it. And so let's go ahead and jump right into it, and here we go.
All right, I want to break down traditional Roth, but also compare it to investing money outside of a retirement account. And let's just take a regular brokerage account. And this could be something you're investing in stocks or mutual funds or even crypto with. It doesn't matter, but I'll go over how these accounts work and show you the benefits of using traditional or Roth accounts. And then even, of course, compare traditional to Roth. Let's say you decide to just put it into a brokerage account.
Okay, so when he says a brokerage account, what a brokerage account is it's what's considered a regular investment account through a brokerage house or an investment company, okay? And so we can invest it in crypto, stocks, bonds, mutual funds, exchange traded funds. Any investment security can be held in a brokerage account.
Buy stocks. I put that $5K in, do I get a tax deduction? No. There's no tax deduction or tax incentive to put money into a brokerage account. As I'm investing that money and it grows, I've made some money on that. Do I pay tax on that? Yes, you do. No tax-free growth in a brokerage account. You're getting dividends or you sell stock or whatever's in the account for a gain. You're going to pay taxes on the gain. It's going to go on your tax return. And when I pull the money back out, do I pay taxes on it? Well, not really. Only the gains or appreciation you've had in the asset. If you put $5,000 in and it's gone up to 6 and you sell and take the whole 6 out, we only have $1,000 of gain. So the money you put in is not getting taxed on the way out. So that is a benefit there. I've already paid tax on that money in the brokerage account, so no tax on principal on the way out.
And this is all true. What he's saying is all correct here. And you know, the money that we're initially investing in, this $5,000, is money we've already paid tax on. Okay, so this is after-tax money going to work. Now, one advantage he doesn't mention here is the ability in regular accounts to access them before the age of 59 and a half. And so the question becomes, what do you mean 59 and a half? What is this 59 and a half, Scott? Well, in retirement accounts, in tax favored retirement accounts, such as a Roth IRA, a traditional IRA, your 401k, your retirement plan at work, they all have big tax advantages, whether it be tax deferral or tax-free withdrawals later on. And in order for that to be possible, the Internal Revenue Service, our IRS, will stipulate that if you take the money out before you turn 59 and a half, now we're looking at a pre-59 and a half 10% penalty for taking the money out. Now, there are situations where it's good to do that. Most situations are not. We want to avoid that if we can. But the idea is that in a brokerage account, we don't have that. Okay, so we don't have that penalty. So we can access the money before at any time, at any age, without any penalty. So that's an advantage for a taxable account.
But any growth or any appreciation, I'm gonna have taxable gains on that. All right, now let's look at the traditional IRA. The difference here is huge, and that is if I put $5,000 in a traditional 401k or a traditional IRA, I get a $5,000 tax deduction that goes on my tax return that reduces my taxable income, which means I'm gonna pay less tax to the federal government and to your state. Also, as that money is investing and growing, you sell the stock for a profit, you have gains, you could be buying crypto in your IRA or 401k, by the way. That's what we do at Directed IRA. You could be buying real estate, private equity, LLC, small business. It doesn't have to be stock. I'm just giving that as the baseline example here because most people understand that. But again, let's say that this went up to $6,000 in value in the retirement account. You don't pay tax on it. Nothing's hitting your 1040 or your tax return here. So no tax on.
And that's right. And just real quick, going back to the brokerage account, at the end of each year, right about this time of the year, first couple weeks of February, will receive in the mail this is on the brokerage account. This is something, this is on our regular investment accounts. We're going to receive a tax form called a 1099, okay, 1099 or a 1099, and that's going to give us a breakdown of all the taxes that we owe in that account, whether it be interest earned or dividends earned, things like that. Well, in our IRA or in the Roth, we don't receive that 1099, okay? And so it becomes tax deferred. So any dividends received, any interest earned, any growth, any capital gains going on is not being taxed year in and year out, which is a huge advantage long term.
We like that. Now, when you pull money out of a traditional IRA, the downside is once you hit retirement plan age of 59 and a half, there is tax on the way out. Don't love that. But I'm 60, maybe I'm in a lower tax bracket than I was when I was earning that money. I'm pulling it out in smaller amounts to live off of. Hopefully there's a lower tax burden there. That's kind of the mentality of people that love traditional accounts, is they're planning to be in a lower tax bracket at retirement. They got the benefit of a tax deduction as they put the money in. They had no tax on the growth. So every penny of profits that they had, you're got to be reinvested. They never had to pay any tax on it. And the value of that over a 20, 30-year period of investing is huge, because every dollar gets to be reinvested to go buy more assets and grow more benefit and hopefully have a larger account for you when you hit retirement. All right,
love that. Absolutely true. That is definitely correct, and a great mentality to have as you're preparing for the long haul.
Look at the Roth IRA or Roth 401k. This is where I'm at. I prefer to do Roth accounts. I've moved all of my accounts to Roth. I had traditional accounts before. I've converted.
Okay, just because he moved them all to Roth does not necessarily mean you need to be doing that. Just want to note that.
All of them to Roth, but I'm now even contributing only to Roth accounts. Now, the downside to a Roth account, no tax deduction when I put the money in. You threw $5,000 in this year, the IRS is like, good for you, you get a pat on the back, but no tax deduction. It doesn't save me taxes today. Remember, the traditional account is the only one that gives you a tax deduction or incentive today to put money in. The Roth, I don't get it. But the next two reasons are why I like the Roth. Is I'm investing that money and growing it, there's no tax on the growth. Again, just like the traditional, every penny of investment returns gets to be reinvested. It's not going on my 1040. I'm not paying any taxes to the state or IRS. Everything gets to be reinvested, which is huge. Again, looking at a 20, 30-year period of investments and growth. But the last reason here is why I love the Roth IRA and Roth 401k. As you pull the money out at retirement, 59 and a half, there is no tax on the way out. No tax on the gains, no tax on the money you put into it, zero tax to you on the way out. Is the only way to make money growing and investing it in the US and be guaranteed that you will pay zero tax. It's a strategy staring us right in the eye, the Roth IRA and Roth 401k, and you can...
Love this, and this is a great breakdown, and this is all correct and true. One note that we'll get to later in the video, which is the income limits on these things. But as we're looking at this, and we got these three things, right? So at the top there, we've got our brokerage account, and that's taxable. In the middle there, we have our traditional IRA, and that's going to be tax deferred. And then we get down to the bottom in the Roth IRA, and that's going to be our tax-free bucket, okay? And so these are the three main categories of accounts that we're going to have as we get into retirement. And so the question, of course, for this video is which one should we do? Roth versus traditional versus regular brokerage, or which of these three am I looking to do here, Scott? And the answer is it's great actually to have all three options as we enter into retirement. And so we have three different places that we can create what I call tax control, okay? And so we, as the client, as the investor, get to choose which account to pull from and when, and that way we can optimize our tax situation every year all the way through retirement to the very end.
Use it to pay no tax. So that's why I love it. I didn't get a tax deduction to put the money in, but I'm playing the long game here. We're getting growth as we're investing the account, and we're paying zero tax on the way out. Now, since I love the Roth account, I just want to go over a couple other benefits to it and go over a couple of misconceptions people have about it. First of all, the Roth account, the contributions you put in to a Roth IRA in particular, you can put $7,000 in a year. You can take out those contributions whenever you want. So if I had 10 years of Roth contributions of $7,000, 70 grand, and my account's now worth $150,000, I can pull out the $70,000 of contributions at 40, at 45, at 50. You don't have to wait till you're 59 and a half to pull out the contributions that you pull in. Only the growth is what you have to wait to get out till you're 59 and a half. That's a huge perk to a Roth account. I can pull the money out that I put in whenever I want. The next benefit to the Roth account.
Yeah, I mean, I guess in that case, it is definitely a perk to the Roth IRA versus the traditional. But keep in mind, we can do this in a regular brokerage account, which is, any money that you put in, we've already paid tax on it, okay? And so then the question becomes is why is the IRS allowing us to take out the money we put into the Roth before 59.5 without a penalty? Well, the answer is that it's because we used after-tax money. And thankfully, our wonderful United States government cannot tax the same dollar on the same taxpayer twice, okay? And so we've already paid tax, they can't tax us again, that's a good thing.
Now, you can say this for traditionals as well. You can file bankruptcy and keep your Roth or traditional IRA or even your 401k. So it's a great place to save and build wealth because it's protected from creditors. Now, my final comment here, and this is about...
And that's a big one. In the state of Texas, we have really, really old, wonderful laws on the books that are very, very, very concrete, that say, hey, any monies invested into retirement accounts, life insurance, annuity products, things that are geared for retirement are exempt from all creditors, okay? So we get in a car accident, we're running a business, there could be dozens of different examples I can give. Bottom line is that a creditor is coming after us. Any monies that are in IRAs and retirement type of accounts are not subject to those creditors. And only a handful of states have state laws that give these protections. The state of Texas is one of these.
About the Roth, I hear a common complaint of people saying, Matt, I make too much income, I can't contribute to a Roth IRA. And there is a rule on this from the IRS that says if you make over a certain amount of income, 160K single, 200K plus married, you can't make a Roth IRA contribution directly into the Roth IRA. But you can do something called a backdoor Roth IRA. It's what I do, a lot of our successful clients do, which is you put in the annual contribution, $7,000. If you're 50 or older, it's $8,000. It's a non-deductible contribution. You don't take a deduction, and you do that on your tax return. And then you convert it to Roth. It's the same thing. It's what's called.
Right, so yeah, just like he said, a non-deductible Roth contribution. The idea is that we make our contribution. So in 2025, we can contribute up to $7,000 into our Roth IRA, our traditional IRA in this example. If we're over 50, it's $8,000, okay? And so we let it settle in cash for a couple of days. There's no gain. And when we go to convert, right? So you might be thinking, well, wait, when we do the conversion, isn't that a taxable event, Scott? And the answer is, well, yes, but only if there's a gain involved, okay? So if it's just sitting in cash, there's no gain, there's no growth over a couple of days, we go ahead and do the conversion, and now we have a Roth IRA. Thus, enter the backdoor Roth concept.
It's called the backdoor Roth IRA. You can do it at our company, Directed IRA, at Fidelity, any sophisticated financial advisor.
I can help you with it.
Advisor knows this strategy. So don't take the Roth IRA off the table if you've heard high income people can't do Roth IRAs. That's not true. They just have to do backdoor Roth IRAs. Now, you can have both actually. You don't have to pick one or the other.
One note on the backdoor Roth IRA that I think is really, really important that he's not mentioning here is that this concept only works well when we don't have an existing traditional IRA in place currently, okay? So why is that? Well, if we did and it had a bunch of gains in it, and we go to do this backdoor Roth conversion concept, well, what happens is the IRS is gonna recognize that other IRA out there exists. And so when you do the conversion, they're gonna aggregate all of your IRAs together, and you're gonna end up actually creating a taxable event, okay? And so the backdoor Roth, absolutely awesome, great wealth building tool and concept, only works if we don't have an existing traditional IRA already in place.
The other. You might have a 401k at work where you put money in and you take a deduction. You do traditional contributions there. And the company you work for may match it with traditional dollars too. So you might end up having traditional 401k dollars, but then you do a Roth IRA outside of the company 401k because you want to grow some tax-free dollars where this money is going to grow and come out tax-free at retirement. The traditional account is what I call tax deferred. It's not tax-free because I'm going to pay taxes later when I come out of retirement. But again, if you're chasing tax deductions now, I'm trying to lower my tax bill right now. And a lot of end of year planning for our clients is we're doing traditional accounts because they're trying to save money on their taxes today. So there's different mentalities to this. There's different reasons to do one or the other. It depends on whether you're worrying about taxes now or having tax-free growth.
And this is the base concept, right? And so I as far as giving us an answer to our question, Roth versus traditional, which one should I do? The official answer is it just depends. And I have run financial plans and done retirement plans where initially I'm thinking, okay, this is gonna be a great recommendation for a Roth. Well, once I crunch the numbers and look at the situation for that particular client, it ends up being that the traditional is the better way to go. And so it really comes down to each person's individual circumstances. And of course, that's where I come in. Of course, shameless plug. You work with a good certified financial planner to develop a financial plan specific to you so that we can answer these important questions. Which is going to be best for us? Do we pay taxes now or do we pay taxes later? Okay, and that's going to be our main question.
Growth and tax-free distributions later. Now, the long haul approach, in my opinion, is the Roth wins out. Who knows what type of taxes we're going to have when we hit retirement? I'm 44. I'm expecting taxes to be higher by the time I hit retirement. Who knows where we're going to land? But the nice thing about the Roth account is I know that account is going to come out totally tax-free at retirement. I could turn a $10,000 account into a...
All right, well, we'll stop the video right there. And so please, in the comments below, let me know what you think of this video. Have you had success using a Roth IRA, a traditional IRA? Which one are you using? And please let me know of any other ideas or videos you'd like me to react to, and I will get the job done for you. Please also like and subscribe to my channel, and that way you won't miss the next video. So thank you so much for tuning in, and we'll see you in the next one. Thank you. Bye-bye.